Hey everyone, welcome back to the channel. It's Ben Morales, your personal financial coach and consultant. And I want to get right into the video today. I'm going to show how I'm helping a family get out of debt. And I'm actually going to show how in 6 months they can really reposition themselves and take better control of their finances. I'm also going to be showing how they got from a negative cash flow. This family is actually in a negative cash flow right now. As a result of that, they're on the fence whether they want to keep the home or they want to sell it. They do expect an increase in income here in the next 6 months, but in the meantime, what can we do in those 6 months that will help to calm the waters a little bit there on their behalf? So that's what I'm going to show today. This is a family that about 3.5 years ago, they bought a home. They bought the home. They put 10% down when they bought the home, and they bought it just about 3.5 years ago for $180,000. Now, since that time, their mortgage now has dropped because they've been paying for the last 3.5 years. And so they already paid $7,190 toward bringing that principal down. The challenge with them now is they are, like we do a lot of times, we look at the client profile, and as you can see, their income is 3,400. The expenses are 4,004 and 75 cents. Now their combined debt, which is made out of their mortgage and also a TSP loan, which is their thrift savings plan loan, they have to borrow from there because of shortfalls, and they've also gotten help from family and things like that. So right now their cash flow is negative 604 and 75 cents. So yes, on paper it looks very bleak, but it isn't that bad because we're going to show you exactly how we can turn that around very, very quickly. They do have $10,000 saved because they're trying their best to do the right thing. They're following all the advice that they've been given. Make sure that you have your emergency funds. That's about 3 months of expenses for them. Well, they are at that point right now. They are at that point. They are considering the refinance, but the challenge is, and this is the other part of the other side, or the other side of the coin that the bank doesn't tell you about. They have a 4.75. So if you only focus on the rate, you're going to think that you're going to be missing out on something by going into something that, even though on paper has a higher rate, is actually a better product for you. And we're going to talk about what that is. So what does that payment look like for them? They brought it down in the 3.5 years that they own. Now they have a balance of 172,801 and 14 cents. The entire payment is made up of 1,761 and 43. Again, that's the interest rate. So when we look at their current situation with that 4.75%, because it is a mortgage, we know that when it's a mortgage, it's upfront loaded, right? You make a payment, and a portion of that payment goes toward principal. Another portion of the payment goes toward interest. And that's what this is. Out of their $983.97 principal and interest, $255.87 are impacting the principal, right? That's why they've only gotten down to $7,190 in the 3.5 years that they've owned it. The other $683 is going toward interest. So that's a massive, massive disadvantage for them. How are they ever going to pay this mortgage off? This is why the bank does it for 30 years, because they want to make as much money as possible while you're in that mortgage. To make things worse, the bank controls the escrow, meaning that what? These are additional costs to this family that really they do not have to be paying on a monthly basis. These costs here are made up of the taxes, the homeowner's insurance, the shortage, which is what happens when you do a mortgage. If the lender is going to be short from paying from their responsibility that you gave them to pay the escrow, then they will charge you a shortage, and you will add that shortage to your mortgage payment on a monthly basis. That's what's happened. Throughout the course of the 3.5 years, their taxes have gone up, homeowners insurance have gone up, they have a shortage, and now their mortgage payment has gone up. Meaning that when we combine all of this shortage numbers, that's an extra $822.46 that is going directly to the lender. So we have $822.46 going to the lender that is not serving the family at all, right? And that's partly why they find themselves in this cash flow position. Not to mention, in addition to this, they have that TSP loan that I talked about. and that loan is also $117.88 payment. Now they could certainly take from the $10,000 and eliminate that loan. It's just over $3,500, which would give them $117.88 back. But what if there is another way? Well, we're going to look at that way. We're going to be leveraging a HELOC, right? We're going to be leveraging a first position HELOC. That HELOC has a special promotion going on right now for 6 months at a 0.25, which is a phenomenal deal for this particular family. So whatever happens on one side has to happen on the other side in terms of our four key numbers. So now let's just take a small snapshot. We're going to look at their current cash flow, which is $604.75. What is happening though is we're going to get some of that cash flow back because that $822.46, now that we are going to be repositioning our mortgage, okay, we're going to be repositioning it from the mortgage into a line of credit, and we're going to leverage the value of the home, which is $250,000 at an 80% LTV. So our home equity line of credit is going to be $200,000. In that $200,000, because we are combining the mortgage and the TSP loan, the total is going to be $176,385.32 that now we are going to send over and put that into the home equity line of credit. And for the first 6 months, it's going to have a rate of 0.25. Now, when we do that, we are getting two huge dollar amounts back. We're getting the $822.46 that was going to the lender, and they were doing us the favor of paying it off for us, right? So we're getting that back. And the reason why we want to do that is because we only have to pay taxes once or twice a year. So does it really make sense to send on a monthly basis that escrow payment of the taxes to your lender when you could be applying it to pay down your principal? I think it makes a lot more sense to do that. And the same holds true, for example, with the homeowner's insurance. If you pay the homeowner's insurance yourself and you do not have an escrow account, then you retain control. You send that payment once a year when you have to. Then what that will do, it would also eliminate, because you no longer have a mortgage, you're going to eliminate the private mortgage insurance, and you're not going to have to worry about a shortage because you are in control. You are the ones that are paying the all the taxes and all the insurance and everything else yourself. You're no longer giving the authority or the right to the bank to do that. And when you do that, they get to make the rules and you have to follow them. So you're going to get those $822.46 back. You're also going to get, because you don't have a mortgage payment anymore, the difference, right? That difference between the 822 up from the 1761 is $938.97. So essentially that 1761.43, you're actually getting that back. So you're getting more cash flow back. What does that look like? You're like, okay, now we've done all these changes. We've gotten a new cash flow now of $1,156.68, simply because you are no longer sending that to the lender. They're no longer separating an escrow for you and principal and interest payment for you. All that is you're retaining control. You are now retaining control. That is going to put you in a positive cash flow. But like I said a few minutes ago, whatever happens on one side has to happen on the other. So if our cash flow now is going up, that means there's going to be an impact as well to our expenses. And that's what's happening here. Remember, at the beginning, we were at $4,475. That was our expenses. But now we are going to be deducting that $1,761.43, which is these two numbers combined. So our new expenses on a monthly basis is going to be $2,243.32. Now comes the good part, because now we're going to start utilizing that home equity line of credit that is in the first position, and we're going to utilize it as if it were a checking account. So when we get income, like this family will get income twice a month, right? Every other Friday, they're going to be getting income. When that income comes in, they will be placing that income inside the home equity line of credit, and it will count toward a payment. So what I did is I broke down what that's going to look like for the first 6 months. Remember, we still have, as an emergency, just in case, the $10,000 that they had in savings, that at this point we have really not done anything with it. We can do later. We can do it at any moment, but I just want to show you if we just left it exactly where it's at in the savings account. This is what it would look like. Month number one, $176,385.32. Now, Throughout the course of the month, there's going to be getting income. The total of the income throughout the course of the month is $3,400. But throughout the course of the month, we know this family is going to have expenses, and we already established that the new expenses with the changes that we've made are going to be $2,243.32. Now, we have to add back those expenses because they're going to be added right to the cash flow and to the home equity line of credit throughout the course of the month, and we have to add back the interest. That's what I've done here. This dollar amount, 176,385.32, at an interest of 0.25, which is the beginning of the promo period, that is going to be make the interest payment $36.30. So that means that at the beginning of month number 2, we have $175, 264.94 as the new balance. Now, something very interesting is going to happen during the course of the second month. They're going to have the interest coming in, or rather, they're going to have the income coming in. But the bank is also going to give them a bonus for doing this home equity line of credit with them. And they're going to receive a $2,000 check 30 days after they close, which they will take that $2,000 check and they will apply it right back into the home equity line of credit. And that's going to count as an additional payment. So 2 payments from the income they're going to make, another $2,000 check. So in this particular month, the second month, they're actually making 3 payments to the home equity line of credit, which obviously is then impacting the rate by which that balance is going down. So when we look at that, 2,000 is going in as a bonus, 2,243 and 32 is coming out as expensive, and only $36 is going to be added for interest, which means that at the end of the second month, they will owe 172,144.26. All we're doing is we're going to rinse and repeat. We're going to see how it impacts the third month. Expenses or income is going in, expenses are coming out, interest is being calculated. There we can see the fourth month, the same thing. Income is going in twice a month, expenses are going to go out throughout the course of the month, interest is being added back in. That's month number 4. Look at month number 5, already down to $169,000, 901.40 cents. Again, throughout the course of that month, their income is going to be going in, their expenses are going to be coming out. We're going to add back the interest. So at the beginning of month number 6, we are down to $168, $779.52. $168,000, sorry. $3,400 is going in, expenses are coming out, and another $3,480 in interest is being calculated. Now, this is what I really, really love. All this we achieved in a point of 6 months. What was the impact to this particular principal and loan, bringing down the balances of the loan that they did have? We started with $176,385.32. We were combining what they owed in the mortgage. We also combined what they owed in the TSP loan, and we got our cash flow back. At the end of 6 months, there's a new balance of $167,657.64, meaning that in 6 months, they made an impact to the principal of these loans, that both loans that they had, of $8,727.68. Now draw your attention. Look at the 8,727.68 and look at the 7,190. They did this in 3.5 years. That's the total principals that they have paid down in 3.5 years, with an interest rate of 4.75 in a mortgage. When we switch that up and we take control and we start utilizing a home equity line of credit, look at the impact. Obviously, because of the low interest rate for the first 6 months, almost $9,000 in additional principal has been paid off to their debt that they owed at that particular time. Now, at the end of this period, yes, the interest rate will probably be somewhere between 6 and 6.5%, according to the Federal Open Market Committee and their meetings and things like that, and what things that they're talking about. So we know that at the end of 6 months, we're going to have lower interest rates or lower balance on what is owed. At the end of 6 months, they can take the 10,000, or actually any time during this cycle, they can take the 10,000 or a portion of the 10,000 and continue to apply it here to this particular balance, which will bring it down to a total of $18,727. They have way more options than what they had when they had started. They could actually take the $10,000 and do some home repairs that they were thinking about doing it as well. So this gives them way more control. This gives them a lot more hope in terms of what can be done in the 6 months while they are waiting for their additional income to start. Because after the 6 months, they're going to get additional income. Then the process of really speeding down and accelerating the payment of that home equity line of credit is going to start, because their cash flow is going to go up significantly. So this is the possibilities. These are the things that can be done when you retain control of your financing and you stop giving control over to the banks and you got to follow their rules. So remember, you're in charge. You can make a difference. I know that this definitely is going to work for this family, and it can work for you. So I'd love to continue to do these videos. So if you have any ideas, anything that you would like for me to cover, please let me know. Thank you for tuning in today, and into the next video. Don't forget to like, subscribe, and share it, and I will see you at the next one. Take care and God bless.